How's everyone doing today? Welcome to today's lecture from Veritas Financial Analytics. A little background music. I thought it'd be festive. That's Material Girl by Madonna, for those of us who grew up in the 80s. For today's lecture about materiality in the federal securities laws. Yeah, I thought you guys would like that one. All right, so to dig in to this question of materiality, I want to give you, today, my goal is to give you the tools that you can use as a practicing lawyer, practicing in fields that use the concept of materiality in determining whether a material misrepresentation has been made. I want to give you the tools you can use to leverage the expertise of financial accountants and economists, as well as industry expertise and ultimately sometimes legal expertise, to figure out this interdisciplinary question that's so important in securities fraud, in general white-collar fraud, in corporate governance litigation. By way of introduction, my name is J.W. Verrett. I'm a professor of securities law, corporate law, banking law, and of forensic accounting at the George Mason Antonin Scalia Law School. I've been teaching there for about 15 years. I also run a consulting firm called Veritas Financial Analytics, where we work as expert witnesses in court in securities and corporate litigation, doing economic damages determinations in general commercial litigation, things of that nature. Okay, so today we're going to take 15 or 20 minutes to dig into some concepts of how materiality will play into your case and how to leverage expert witnesses so they're useful for these questions of materiality. So let's focus on materiality as a concept in securities law, in securities class actions, in securities enforcement work with the SEC, and in corporate governance matters that use the same concepts as those in underlying securities law. But some of these questions of materiality can really cross over into all sorts of areas of law, in which pretty much anywhere that fraud is a question at issue. Materiality is a cornerstone concept in securities litigation. Essentially, for the misrepresentation to matter, for it to be actionable, it needs to be material. So materiality is a cornerstone concept that comes from the common law tort of fraud that helped to create the federal securities laws. And the most important takeaway I want to leave you with today is that the question of materiality, determining whether or not a statement is material, is an interdisciplinary question. It can bring in all sorts of different disciplines. The core ones will be law, accounting, and economics and finance. But they might also bring in, the questions of materiality might also bring in expertise from all sorts of different areas, usually with respect to the underlying industry in which the company at issue is working. So don't let your question of materiality get boxed in. Oh, that's just a question of law. Oh, that's just a question of accounting. No, it's interdisciplinary and usually will require multiple disciplines. So how is it defined in the federal securities laws? Materiality is defined using a couple of different kind of phrases. Like everything else in law, there's always the magic phrase, the magic words to define it. And then we really only get the definition over a series of fact patterns, over dozens or hundreds or even thousands of fact patterns and cases. But the core, the initial magic word, is phrases like it's material if a reasonable investor, the sort of reasonable person standard from tort law, is brought in by analogy. If the reasonable investor would consider it important in making an investment decision or a decision about how to vote in a corporate matter, would consider it important. Now note what that doesn't say. That doesn't mean the information would change their decision, the reasonable investor's decision. It would just be a piece of information they would consider important in deciding whether or not to buy or sell securities, whether or not to vote a certain way with respect to a vote on securities. Another way it's defined in a case called TSC versus Northway is that information is material if it would alter the total mix of information available. This means that if the truth of something is already out there in the public sphere, then the fact that a fraudulent statement was made might not necessarily be material information, given the total of mix of information that was already available out there. This is a question that comes up a lot in cryptocurrency cases. In the field of cryptocurrency, most everything interesting that's happening is happening on a blockchain that is stored publicly across thousands of computers around the world and readily accessible through blockchain explorers that take that information that's readily accessible to anyone and makes them even more easily accessible to the average user on a blockchain explorer where you can see transactions. I've encountered this issue before in wash trading cases and market manipulation cases where there's an allegation made that wash trading or manipulation is going on. And on the other hand, it's always necessary to consider that if the pattern of transactions happens on a blockchain, they're out there for everyone in the world to see and to easily collate on a blockchain explorer. So the fact of what might otherwise be manipulation in another context suddenly is not manipulation in this context, potentially. Other things to keep in mind from the definition of materiality: it's been applied with respect to omissions and to affirmative statements. Materiality is an essential element of a 10b-5 action in securities enforcement and securities litigation matters. There's a few different lenses through which to view the question of materiality. One is just a legal lens. You'll encounter some legal cases where a judge will say, look, I just know this is material. This is certainly material. Now, you might ask yourself, is that judge ruling that as a matter of law, or are they taking notice of something judicially as a question of fact and just not allowing it to go to the jury? And sometimes it's unclear, but you'll encounter securities cases where there's an opinion that just says this type of information is always going to be material. I can think of one case in which a judge said, look, in the mortgage underwriting business, where a mortgage firm repackages mortgages into a different type of security, kind of like a Fannie Mae operation, the underwriting process, information about the underwriting process is undeniably material. It's just a question of my ruling. Whether that's a ruling of law or not, it might be arguable, but the ruling is there, and then it's been cited as a proposition of law in subsequent cases, and it kind of starts to take on a life of its own, when it really is still, I would argue, inherently a question of economics and accounting and the disciplines that can test materiality. But you have some case law that's rigid about particular types of information. Through the economist lens and through the finance lens, you're looking at precedent that considers one way to measure materiality, not the exclusive way in most circuits, but one way to measure materiality is to look at stock price impact. If you have a nice, clear fact pattern where there was a fraud, a misrepresentation, and then subsequently the truth comes out, and then you can look at the stock price impact as a result of the truth of the fraud being revealed. If you can show that there was no stock price impact, then you have an argument that the information was not material, and therefore the misrepresentation itself was not material. Now, the fact pattern will not always be that clear and that clean. For one thing, you'll end up in a battle of the experts about whether or not the particular model of stock price impact was valid, whether or not a particular model took into account all potentially confounding events. And one side might, as part of a battle of the experts, say, well, look, I see a confounding event that's not taken into account in your model, and as a result of that, there was or was not a stock price impact that you did not otherwise take note of. But ultimately, that's how the tools of economics can be useful to help with materiality questions. From the perspective of accountants, there's a few different ways in which materiality comes into play. First of all, generally accepted accounting principles have their own guidance about materiality. Now, the codification of that guidance is written in such a way that it's intended to be consistent with the law of materiality, the securities law of materiality. But because the securities law of materiality is somewhat indeterminate, um, I would give accounting analysis of materiality its own independent utility in federal court. You can find that within the definitive codification of GAAP. You can find that within SEC pronouncements about what is or is not material that might come from the SEC Chief Accountant's Office, like Staff Accounting Bulletin 99, which is the kind of leading articulation of how the SEC accounting team views materiality and their focus on the dichotomy between quantitative materiality and qualitative materiality. This represents what I think I'd accurately call a little bit of pushback from the accounting side against a pure quantitative definition of materiality coming from the side of the economists, right? So that's one battle of between those two disciplines that's going on, and you see it reflected in Staff Accounting Bulletin 99. So I just keep an eye on that. Otherwise, continuing on with some basic points that I wanted to put in your head so that later we can talk more about it. There are increasingly issues being litigated about the materiality of uniquely non-financial information. Maybe there's a scandal at the company, and there's assertions that the scandal is material, or the company's reaction to the scandal. But then again, it can still be a question of quantitative issues, because at your largest conglomerate, there is some sort of investigation of something going on all the time around with multinational operations around the world. There's something happening all the time. So you can't be in a state of kind of permanent hyper scandal disclosure. Otherwise, the market can't really use that information. So you still are stuck with how big a percentage of the company's relevant financial universe is this issue as a way to proxy for materiality. So while I think the quantitative aspect of materiality is useful and interesting and a part of an accurate articulation in SAB 99, I also think that quantitative anchor is always going to help you, at least, even if it's not the type of environment where a stock price impact study will be useful. Just the analysis of comparing the potential financial impact of something against a total indicator like total revenue, total assets, total debt, one of those bottom line elements of one of the financial statements, as a way to get a ratio analysis so that you have some quantitative estimate of the impact is inescapable. So I think that dichotomy will be with us for a long time. I won't belabor too much the legal framework for materiality beyond what I've already shared, because today's discussion is intended for an audience of lawyers, and y'all pretty much know the legal framework. You're already prepped up for that. You need to know how to use experts in this context. One thing I will warn you: keep an eye on the Supreme Court case Matrix versus Syracusano from 2011. It says something, but it doesn't say. People often confuse that it says more than it purports to say. Let me say what people often say about it that's wrong. People often cite it for the proposition that, okay, you don't have to have statistical significance to show materiality. It's not quite what it says. What it says is that issues might be material despite the fact that they come from a medical study that doesn't show statistical significance. In other words, statistical significance to the question of stock price impact is still as important as ever to the question of materiality, when that tool is appropriate for determining materiality. That's unaffected. All it says is that if the underlying issue is some other type of study, like a drug efficacy and safety study, the fact that there's no statistical significance in that underlying study doesn't mean the issue in question there might not be impactful on the stock price, and maybe even statistically significantly impactful on the stock price. Maybe the point there is that the reasonable investor might be a little bit more excitable about issues that are triggered in scientific studies, even though they're not statistically significant, right? A drug study that shows that we found some association for a really, really horrible thing, but it was not a statistically significant association. Maybe the reasonable investor is hyper risk averse, and for a biotech company that's bet the farm on only that one medicine, might see still an impact on stock price as a result, as a reaction to that news, and the investors might be kind of ignoring the fine print. And whether that's the right way to interpret science or not is really not the question. The question is whether a real stock price impact actually happened, such that it would demonstrate the materiality of information. So statistical significance still matters. It's just that it doesn't limit information to only statistically significant information. Statistical significance particularly still matters to the question of stock price impact studies. To the particular question. That tool is not really the type of statistical significance the Matrix case was talking about. Anyway, we can talk more about that in a follow-up call after you listen to this great primer and feel like we need to talk further. The reasonableness of stock price impact is measured at the time of disclosure. It's not measured through the benefit of hindsight. Not supposed to be measured through the benefit of hindsight. So I'll say there's one type of determination of materiality that judges tend to make, and we could debate whether they do so as a point of law or as a finding of fact, but and as a finding of fact in summary judgment rather than leaving it to the jury. Anyway, there are some cases where there are just categorical determinations of materiality, where courts hold in early motion practice of summary judgment, motion dismiss, they will have holdings that a particular class of information is categorically material. Let's just go with that word to be safe. A categorical determination of materiality. Overstatements of revenue, improper accounting practices that inflate results, failure to disclose major liabilities or risks, when they're intended particularly to meet quarterly earnings expectations, are deemed to kind of categorically be material. Now, we can debate how to classify those legal rulings that are making that determination, but it's a categorical kind of a determination. And this is reflected in subsequent guidance, accounting guidance from the SEC, trying to put some meaning to the question of materiality. Merger and acquisitions information, sort of deemed to become material and fairly early on in the likelihood of the merger actually being consummated. This is partly a finding of law in Basic versus Levinson, in which the court offered a kind of a test, kind of a materiality weighting test that says, look, the materiality of something is a result of the probability of its occurrence. If you're trying to weigh the materiality, looking into the future of telling investors about the possibility of something happening in the future, things become more material as a result of this weighting mechanism of a simple equation of the probability of the thing occurring multiplied by the magnitude if it does in fact occur. And in Basic versus Levinson, the court said categorically, mergers and acquisitions are high magnitude events, bet the farm events, and for the target firm, it means as a shareholder you're no longer going to be a shareholder in that firm. It's a life-ending event for that firm as an independent entity, as you know it as a shareholder. So that's a high magnitude. That's the highest magnitude event, and therefore much lower probability events of that occurring, like early stages of negotiations, become material much quicker. So that's a finding in Basic versus Levinson that's then elaborated on in subsequent courts. And you can think of the Basic versus Levinson test as another way to think about the materiality question. Similarly, there have been categorical findings that the fact of an SEC investigation of a company might be itself material, and the company's disclosures about the fact of the SEC's investigation might be deemed material. As you can imagine, the SEC certainly thinks their own investigations are material. Conflicts of interest, key issues about key personnel, like, for example, if there's criminal history to someone in the C-suite that was undisclosed. There are some cases that say, okay, that's categorically material. You get into undisclosed risk factors or defects with key products, operational setbacks. There are some cases that find in a particular context those types of information are material, but they're usually underlying getting the benefit of some expert in the field itself, an oil field expert, an environmental expert, who's there to say this is categorically material in this industry because it's the type of thing where it can blow up and suddenly it's spilling out 100 times as much oil as it was before because of this type of issue that you need to be an engineer to know. And so at that point, you're adding to the toolkit of expertise that can help you determine materiality. You're adding on top of the normal legal, economic, and accounting expertise. That's the core of materiality questions. You're adding onto it something else, like an engineer, like a scientist, like an industry expert. If it's an advertising company, it could be an advertising executive. It's going to help you determine questions of materiality for that particular industry. In the accounting side, you've got you start with for the Financial Accounting Standards Board and Generally Accepted Accounting Principles, and I've been privileged to serve as an advisor to the FASB in the development of GAAP and serve in the Financial Accounting Standards Advisory Committee. You start with concept statement number 8. That is FASB's way of codifying in the accounting codification, the definition of materiality and helping to elaborate on it. SAB 99 is the SEC's view on materiality. You start with the kind of a rule of thumb that was used in the 90s at the time the SEC wrote this up. A rule of thumb that says, okay, the 5% of a major category of financial information is material. So if some issue is less than 5% of a company's net revenue, gross revenue, net revenue after sales allowances, net income, net earnings, whatever you're using, if it's less than 5% of that, it's not a material item. That's a rule of thumb that it's okay to start with, but the SEC makes clear in Sub 99 you can't end there. You need to have something more than that. They don't tell you where you can end, but they do tell you that you cannot only use rules of thumb of that nature. So you have to think about qualitatively, does it seem like this is something where someone in the company was trying to artificially meet a sales target? Well, then that suddenly becomes very qualitatively material, even though it might not be quantitatively material, even though it's only 1% of the net revenues of the company. Other types of things that suddenly become more qualitatively material, whether the misstatement concerns a segment or portion of business identified as playing a significant role in operations, whether the misstatement changes loss into income, net income, or vice versa, whether the misstatement hides a failure to meet analysts' expectations for the quarter. That's a big one. That's probably there for most of the revenue fraud cases the SEC brings. Whether the misstatement demonstrates a failure to meet loan covenants, whether you're trying to hide a failure to meet a loan covenant from your bank or from your bond trustee. Other issues to keep in mind here on the economic side, you'll get into a standard kind of battle of the experts about model versus model. The economist view perspective on materiality and the stock price impact studies that they do can be useful in a couple of different ways. It can be useful for damages, they can be useful for loss causation, and they can be useful for materiality. So that similar type of study can be useful for three separate elements of securities litigation. And then in that, as that battle of the experts develops, it can be useful as an expert if I was giving a lecture to a group of experts to hone their craft, or to lawyers trying to figure out how to use experts. I would say get the model right first, or the analysis of accounting guidance first, or the analysis of some other underlying field. Get it right first from a pure professional perspective. Be willing to think creatively about the interdisciplinary issues you're bringing together. So I'll just share one anecdote, if you'll indulge it first, and then we'll close up. I worked recently on a case, SEC versus Red Rock. The deposition's public, so I can talk about it. The case involved an allegation that the sellers of silver coins were not telling the buyers of those silver coins that they were sold at a markup. That the allegation was that they were being sold at a markup to the price of the silver, the value of the silver in the coin, and the percentage markup was not disclosed. So the question became, is that material? Is that a material omission? Is that a material omission? There's a couple of points that I offered in a report on this matter that I thought worked against the notion of materiality. First, the fact that the buyer already had information about the number of ounces of silver that were in the silver coin. That was provided as part of the sale. There were documents sent to every buyer. And the name of the coin included the number of ounces, half an ounce or an ounce of silver contained in the coin. The price of silver, the per ounce price of silver, is available on yahoo.com. You can Google it. There's a million places that have the current spot price for silver for that second of the day. So quick Google search, and you use the calculator on your iPhone, and you know exactly the cost basis of the silver coin, and you know exactly the purchase price. And so the markup of base price to purchase price is easily calculable. You don't know the price at which the selling firm bought, but that's also a question that brought in a second level of interdisciplinary thought, which is, okay, the SEC said, all right, fine, you know the cost of what you're buying, and you know the value of the silver in what you're buying, but we think it's material that you didn't share your own overhead allocated to this silver as a seller. And therefore, what you say is markup, what you define as markup, we define in a certain way to say it was you were lying about your own profit on it, even though the buyer knew the value of what they were buying and the purchase price of what they were buying and the difference between the value of what they're buying and the purchase price of what they're buying. To which I offered some basic cost accounting methodology and said, here's a primer on the field of cost accounting. There are so many different ways to allocate overhead for a product. And there are methodologies in cost accounting that reasonably allow the allocation of just about all overhead to a product. And so using this option, the menu of options available in the field of cost accounting, includes options that make even the disclosures about their own profit basis accurate and correct. So on a basis of just pure total mix of information, that's just me as a forensic accountant, just looking at the information readily available. And secondly, doing a deep dive on cost accounting and saying over representations about the quote unquote markup on the value of what was sold were still accurate based on a reasonable interpretation of the field of cost accounting itself. I was able to offer a report in support of the defendant's case. So that's harnessing kind of multidisciplinary. Throw a little cost accounting in there. Throw a little economics in there. And also the question of opportunity costs and basic concepts in economics, like the question of opportunity costs, were also included as a part of the report. So it's an interesting multidisciplinary area where you can think creatively about how you use different types of expertise. That's what makes it, I think, unique from other elements of securities litigation and corporate governance litigation. In that, in the others, I think you're often cabined to a specific type of expertise. Like in damages, you need to have either a forensic accountant or an economist using a particular type of tool. But in materiality, you have a much wider set of expertise that can speak to the ultimate question of whether or not the representation or the omission was material. I hope that this has been useful. I hope that you all have enjoyed this discussion. I hope that I hope you'll give me a call. If I can help you in any way, we have a stable of experts here at Veritas Financial Analytics. We have a team including, I'm really proud of the work with Dan Taylor, who's a forensics and analytics expert who teaches at Wharton in the accounting department at Wharton and does some deep dive forensic data stuff. He's done for DOJ, he's done for plaintiffs, he's done for defense side. We've got folks, some of the top universities in the country, Columbia Business School, Economics Department, George Mason, and myself, who is both a securities law professor and a forensic accountant, and been advisor to the SEC and to the FASB. We love to sit in the deposition chair and tell the truth and share our perspective with courts, with litigants to help resolve legal matters. Give us a call if we can help you in your matter, or if you just want to talk about these issues in a little bit more depth. Hope you all are taking care, doing well, and stay in touch.